geopolitical risks are usually over exaggerated. And so when the reality show up that it was actually over exaggerated, the market rallies very hard. So you don't have to panic sell, rather manage your risk.
And there's a lot of uncertainty in the market. The market is in a state of uncertainty, and investors are actually shouting. What should they do at this point? Should they sell off?
If you think you are overexposed to a sector that might come into the crosshairs of the geopolitical conflict that we have now, then you might want to trim your position.
The headlines are screaming at us about the U.S Iran wars. And there's a lot of uncertainty in the market. The market is in a state of uncertainty, and investors are actually shouting. What should they do at this point? Should they sell off? Or should they buy oil stocks because they are going high? Or should they buy defense stocks because they are going to produce more bombs? Now, that's why we are here today, to actually show you both the direct, the indirect, and the long-term effect of these tensions on the stock market. Welcome to Clockwise. My name is Providence, and today we'll be discussing the economic effects of these tensions in the Middle East on the stock market, what you need to do, and how you need to stay safe. And as usual, my guest is here to do this conversation with me, my in-house stock market analyst and researcher. With a virtual round of applause again, please welcome Mr. Kanem. Welcome again to Clockwise.
Thank you very much, and thank you to the viewers.
Do you have anybody in the Middle East? Maybe in Dubai?
I have a friend of mine. I spoke with him yesterday. He's working with the Qatar Energy Corporation.
What is the level of damage?
He told me that I just called him and asked him. I said, Nathaniel, what's happening? What are you guys? How are you dealing with the fears? They said they are now immune to fear. Because if you look at, I think one of the targets of Iranian missiles has been the Qatar LNG infrastructure. And if you know that this is the largest LNG infrastructure in the planet, then you know that this portends a lot of danger to the global energy supply. Not just that, even Saudi Arabia, you know, their refineries have been under attack by Iran. So that also means that a whole lot of disruption is expected in the global energy space.
Now, overall, let's look at all this, the effect this has on the stock market. First, let's look at the indirect effects it has actually in the stock markets.
Whenever you look at the global economy, you should know that the global economy runs on energy. So what happens in the energy sector affects the global economy. Because if you look at things like, even look at goods and services, these are moved primarily through energy. Even if it's air, you're talking about jet fuel. You look at land, trucks use diesel, use gasoline, and all of that. So anything that affects the energy space disrupts the global economy. And so we've seen what has happened, the escalation of conflicts in the Middle East, the fact that the U.S. and Israel, Iran was, according to Netanyahu, that's the Prime Minister of Israel, Iran was weeks to developing a nuclear weapon. And so that's why the U.S. intelligence, the CIA, the Israeli intelligence decided that it was the right time to actually launch the onslaught. And so that, of course, led to the death of over 41 top figures in Iranian regime, including Ayatollah Khamenei. So in a reprisal attack, Iran has been targeting countries with U.S. Navy, U.S. military assets. For example, you've seen attacks on, and by the way, these are Gulf states. You have Saudi Arabia, you have UAE, you have Qatar, you have, most of the countries within Kuwait, it's also under fire too. So that's a big deal. And the reason is because these are countries. For example, Saudi Arabia does literally over 10% of the global production. But beyond that, the biggest damage that this has caused is the fact that shipping has halted on the Strait of Hormuz. Let me tell you what the Strait of Hormuz is. It's a very strategic waterway. It's a very strategic maritime gateway, moving from the Persian Gulf down to the Gulf of Oman. Now, at its narrowest point, it's about 33 kilometers in width. So what that means is that Iran literally has control over that particular waterway. So the Iranian regime has vowed to set on fire any ship that passes through. Now, when that happens, you should know that the Strait of Hormuz does 21 million barrels per day pass through that. So that's about 20% of global petroleum liquid supply. So that's very strategic. So you're looking at Saudi Arabia, you're looking at United Arab Emirates, you're looking at Iraq, all of those countries, they have to move. You cannot take through. The alternative is to take through Africa, which would be insanely prohibitive in terms of cost. So you have to use that Strait of Hormuz. So Iran says any ship that threatens that any ship that passes there, any oil vessel, tanker that passes there, be set on fire. So what you now have is that insurance companies, every ship that passes, you're talking about hundreds of millions of, I said 21 million barrels. What is one barrel? One barrel is about, current price with this escalation, it's about 80. Let's take it at 80. You're looking about 80 times 21. Think about that. 80 times 21. That's about, it's about 1.6 billion. Think about that for a second. So that's an insane amount of value that is passing through that particular waterway. So insurance companies are not very comfortable with with providing coverage to such and taking such a risk. So you have crew, you have shipping companies, you have insurance companies, most especially saying, listen, we are not going to take that risk. So that's why if you look at on the map, so the trackers, the vessel trackers, you realize that so many vessels are just sitting on the sidelines. Nobody wants to cross because of the risk. So when you have this stall out in terms of energy transport, it affects. That's why you've had Brent has shot up from 67 a couple of days ago to now it went as high as 84. And I'm sure by the time we see this video, it may have crossed 100. So that is the biggest challenge that happens. Though Donald Trump had already directed, effective immediately, as at yesterday, 3rd of March, he had directed the United States Development Finance Corporation to provide what we call a financial backstop, provide some form of insurance to vessels that are using the. In fact, he also mentioned that if it becomes necessary, the U.S. Navy might be escorting vessels as they pass through the Strait of Hormuz, just to be able to ensure that global energy supplies continue to move. Remember, there's a very strong linkage. If energy supply is constrained, what will happen is that the prices will go up. When the prices go up, that will mean not just price of energy, but price of shipping itself would go up. That would mean that the prices on the shelves would go up. What is that? That's inflation. Isn't it inflation? Yeah. You have an inflationary environment. That means that the Fed might not be thinking about cutting. As a matter of fact, cutting rates. As a matter of fact, a couple of days ago, the odds of a rate cut this year was 100% for 2 rate cuts this year. As I speak with you, that has dropped to just 1 rate cut with a less than 60% chance of a second rate cut. So you have those rate cut expectations have continued to get dampened because of the inflation expectation due to the expected rise in the price of crude. So when that happens, of course, you know that it also has a way of directly affects the bond market. If you look at what has happened, global debt market, global bond market, there's been a serious sell-off. You know that there is actually, for the viewers who might not really understand, but there is a reverse correlation between the price of bonds and the yield on bonds. So when there's a sell-off, bond prices go down, but the yields do what? Go up. When the yields go up, you know what that means? It means that a bond yields going up is very negative for the stock market. That's why you saw yesterday some of the U.S. stock market indices, equity markets. There was a very serious slump yesterday.
All right, now let's look at investing during times like this.
Yes.
Let's say the market is in a state of uncertainty. Nobody can actually predict the next moves of the markets. Anything can happen. That's in the next 2, 3, 4 weeks. So in a state like this, what do you have to say about sector rotation? People selling off their positions just to buy the trending stocks.
Yes, you saw what happened yesterday. We looked at the markets. There was a recovery in terms of the Mark 7. Before, in the lead up to this U.S Iranian conflict, we had a very serious kind of a shaky sentiment in private credit. And you know that private credit actually funds most of the AI startups that you have, AI companies that you have. And so that was already giving some kind of a shaky foundation to the AI story. And of course, by extension, the tech stocks, the US tech stocks, especially the Mark 7, experienced some kind of sell-off. And the reason was because of the fears that AI is going to replace most of the things that they are doing, most of the services that they are offering, or the products they are actually offering. So we had that, but we seem to have a rotation away from into the rotation into these names again. Of course, at this point, you have gold moving. It's been choppy a little bit, but it's moving. Yeah, it's moving gradually up, because I mean, in times like this, everybody runs to to a store of value, which in this case is gold. This morning we had some appreciation in Bitcoin. The Bitcoin has really not fit that narrative as of late, because investors still consider Bitcoin as a tech stock, more of a tech stock than an inflation hedge or a store of value play. So we've had a lot of rotation into some rotation into Bitcoin, some rotation into gold, and some rotation into the Mark 7.
Okay.
The Mark 7 have actually experienced some insane sell-off. We also expect rotation. A lot of people are actually rotating into energy stocks.
Okay.
We saw energy stocks that are rotating into defense stocks. So you have the likes of Lockheed Martin, you have Boeing, most of those, because again, there's a meeting that's happening on Friday between the White House is hosting a meeting with the defense contractors. The war currently might stretch for a long time. And so the US needs to be prepared. So that's why you're seeing some very serious tick up with some of the defense stocks that you have. So those people might want to rotate to capture some of the short-term price appreciation that might come from that. But beyond this also, like they say, you always want to buy when the missile is in the air. Yes, buy the blood on the street, even if it's your own blood. Because historically speaking, geopolitical conflicts like this have not been so sustainable in terms of the impact on equity markets. Yes, because if you look at it, apart from maybe events like the COVID-19 or events like the 9/11, you've really not had such a dramatic move in terms of volatility. Yeah, even with what just happened, I mean, you would expect for the VIX, S&P 500 VIX to shoot above 40, but it's not. It's nowhere near there. So I believe that opportunities still exist. in the tech space, in the US tech stocks. Opportunities still exist, especially those names that have been beaten down because of the AI narrative. IBM, for example, Anthropic announced last week that IBM, that their model can actually solve some of the, can literally replace COBOL. COBOL is Common Business Oriented Language. It's a programming language that runs a lot of the ATMs and all of those financial applications. And then Claude is saying, Anthropic said Claude could actually do it. That's why you saw I think a 13% sell-off on IBM stock. Now, these are beaten down names. You have the likes of Meta, you have Microsoft. Some of these names have been seriously beaten down. So this presents an opportunity for...
So we advise someone to actually buy into it at this point?
Yes, so...
What is the market changing? What is the sharp correction? Like, let's say next week.
So I'm thinking of what would drive the sharp correction. We are looking at what has happened so far and what could happen, what could push the prices lower. If you look at the reality is that the market prices in the worst case scenario very early on. So you might think, okay, we are going to have a lot of very dramatic sell-off. Already, the Strait of Hormuz, it's shut down. Technically, it's shut down. You can literally say that the maximum impact on global energy supply is already on the table. If that happens, then you could be looking at all energy-related sectors, including sectors that are not exactly related to energy, but rely on things like transportation and all of that to be impacted too. Let me give you something to think about. In South Korea literally had to shut down the stock market. Literally, the circuit breakers went off. The market sold off by 12.06% in one single day, eclipsing the event of 9/11. I think it did 12.02% in a single day sell-off. We have another one, 12.06%. Circuit breakers were off, I think, for about 30 minutes. That's to show you. And the reason is because remember that 98% of South Korea's energy is imported. And guess what? There's a lot of reliance on the Strait of Hormuz for that to come in. That's number one. Number two, South Korea's economy is heavily dependent on tech stocks. We've seen a lot of things that have happened. A lot of challenges that are coming in with, especially in the area of shipment. It also affects Iran, but I mean, when you believe you have nothing to lose, you just go completely haywire. So what's the worst that can happen? The worst that can happen is remember that the US, because the context here is actually the US market. The US does the largest oil export in the world. They're the largest producers and the largest exporters. So the only thing is that the U.S. economy, the gasoline price in the U.S. is so directly linked to the global market, oil market. But when it comes to them not having self-sufficiency in oil production, that's not going to happen. After they discovered, essentially that happened. That started 10 years ago when they discovered shale oil. So the point there is that we don't expect a doomsday scenario. We don't expect another black swan event. So though I still believe that the bottom is not in yet, but we might be close to the bottom. How do you gauge when you are close to the bottom? When high impact news no longer yield high impact correction or expression in the market. Yes. Ordinarily, the shutting down of Hormuz, the Strait of Hormuz, should literally crater the market. But we didn't see that happen yesterday. Meaning that investors have already priced in most of these things. They have already priced in most of these events. There is, and by the way, remember, Iran is going to soon run out of their missile supply. Some of the partners, look at the partners, the Gulf states. Iran is literally attacking their partners. So it's like this. Let's say you have a friend. You have 4 friends, and then you are fighting somebody. And then your friends tell you, listen, leave that guy alone. And then instead of you to listen to your friends and leave that guy, you now hit your friends with a baseball bat, or you now literally shoot at them. What do you think will happen? You have turned yourself into an island. You don't have any friends. So if you look at the likes of the terrorist group like Hezbollah and all of those that are like Iranian proxies, these guys have been largely decimated. Yesterday, the U.S. Central Command confirmed that the 11 Iranian ships on the Gulf of Oman are now under at the bottom of the ocean, have been destroyed. Remember that China buys literally 100% of Iranian oil.
Yeah.
So if the Strait of Hormuz is closed, that means Iran themselves can't sell.
That would be the thing I wanted to ask you.
So if they cannot sell the oil, how do they get the resources to continue to prosecute the war? So that's why I'm saying that we are not expecting any more catastrophic impact on the market than what we've seen now. It's been priced in. So is the bottom in? I'm not sure. But I believe that we are very close to the bottom.
Okay, let's assume that this war continues for, let's say, another 1 month, another 2 months, another 3 months. Now, what do you see will be the long-term effect of these wars on the markets?
The reality is this. If this war continues, the concern is on energy prices. We have a new Fed chair coming in. So if you have a protracted war, there's a high chance of energy disruptions. Insurance companies are most likely not going to want to dabble into trying to provide protection for shipments, most especially the oil tankers and all of that. That is expected to push up the price of petrol or petroleum products. Remember, it's not just the liquid itself. Petrochemicals, fertilizers, all of those would be directly impacted by this war.
Okay.
And so from farmers to plastic products manufacturers, to airlines, to trucking companies, to even the shelves, the price at the shelves will be higher. So what you tend to have is that it's like a tax on the American people. It's like a tax. And so when that tax happens, that means when you pay more at the gas stations, that means you have less for discretionary spending. And when you have less, that means your purchasing power is hampered. And guess what that does to the consumer sentiment? It's lower. Once consumer sentiments gets lower, purchasing power is effectively dismantled, then companies can no longer really support expansion. So that's why a trickle effect of this might even lead to recession. Because what causes recession? When demand is completely almost destroyed, then people can no longer buy. Companies produce, inventories run high, and then companies can no longer hire. Just lay people off, and the cycle continues. The more they lay people off, those people no longer are able to buy. That also impinges on the demand power, which by extension also reduces profits and revenue for businesses. So the long term, which I don't think that Donald Trump would want to make this to drag so long. But again, and I'm happy that, Saudi Arabia is even considering also joining the war because Iran is attacking them. So it's not a case of, this is a fellow Muslim. No. That doesn't work that way. Your first responsibility is to protect your territorial integrity. So with the Gulf states teaming together to confront Iran over the unwarranted attack that they have suffered, that means there is a very high chance the likes of Hezbollah, the likes of all those Iranian proxies. Lebanon literally sent a message to Lebanon for the first time, literally told Hezbollah to stay off. Yes. So that means Iran is literally on their own. And there's no better way of ensuring that if the missile launchers, like been hearing from the U.S. Central Command, if you can have 2,000, 5,000 missiles, if the missile launchers have been destroyed, then you cannot launch them. Those missiles are literally useless. Are you going to throw them by hand? No, you cannot. So, with the pace at which the US is taking out the Iranian missile launchers, that means this war might not move into those months or years that you think of.
Okay.
So, but if for any reason it drags that long, it might affect the stock market significantly.
Now, in the course of this conversation, we've actually talked about the winners. Because from what I'm seeing, from what you're saying, is that there are winners to this war. They are the defense stocks, the oil, the gold stocks, and the rest of it. Now, who are actually the losers? Because at the end of the day, we should have stocks that will be losing as this war exceed a particular time.
The industries that are going to lose out, I had talked about the aviation industry, because you know that 60% to 70% of flight cost is actually cost of fuel. So if the cost of fuel goes high, there's an extent to which you can push prices up.
Okay.
Yes. So the margins will be compressed. So airlines that are buying jet fuel at a higher cost will suffer margin compression.
Yeah.
So if that happens, that means that their profit margins really shrink. So when we talk about airlines, we also talk about travel. We also talk about shipping, trucking companies. Trucking companies will also have their margins shrink because the cost of diesel is expected to go up. Literally, let me put it this way in summary. Literally all oil or petroleum dependent companies.
Everything depends on energy.
Yeah, especially the ones that really depend so much on energy. These are going to be like the guys and directly in the crosshairs of this war, this conflict. Yes, because it is going to be a direct impact on those companies. But again, I had talked about indirect impact too. Because if you look at food companies, agricultural businesses, if the price of fertilizer goes up, guess what happens? That means the margins of agro companies will begin to shrink. Then you are also looking at, beyond that, you're looking at other companies, especially discretionary products manufacturers. What I mean by that is, it is when you have leftovers that you can do what? Use to buy some of those things. For example, luxury goods. Because if I'm paying more at the pump, if I'm paying more for groceries because of a tick up in price at the shelf, then I have less income to go for luxury goods, to go for discretionary items. So those are the companies, that's a general broad category of industries that will suffer the direct impact of this attack. So essentially, when things like this happen, you want to be very careful about positioning in the market. I had said the last time that we are on this channel, when we were looking at some of the dislocations that we are seeing in the market, I said, whenever you have conflicts, unpredictable events like this, the last thing you want to have is tiny margin on a leveraged position, especially in whether you are buying stocks or you are buying ETFs or anything that that's most likely going to suffer directly from the impact of this war. You want to be very careful about managing your risk. If there's any time that you want to be put on your risk management hat, it is this time, because anything, like I said, can happen. There's a lot of uncertainty. Also, you want to monitor VIX, the S&P 500 VIX. This is a volatility index. If it spikes, it is always in reverse correlation with the equity market, the U.S. stock market. So a spike in the VIX is most likely going to yield, a crash in U.S. indices. So you want to also monitor very closely, ensure that your leverage positions are reduced. You have a very comfortable margin. During volatile periods like this, liquidity could grow very thin, very quickly. And when that happens, that means that even stop losses might not be triggered. That's what you should know. Stop losses might not be triggered. So you want to ensure that you limit your exposure as much as possible.
What's your own strategy to keep yourself safe currently? I mean, your personal strategy to keep yourself safe currently in the market. How do you guide your portfolio?
I am now full-time into risk management and part-time into trading. The reality is risk management. I am very, very big on risk management at this time. Okay. I ensure that, I had said the other time, what I have exposure to, the portion of my portfolio, in terms of percentage that I have exposure to leverage market is 5%. Okay. 5%. If I suffer a damage, out of that 5%, of course, I still have, that's the part that goes into leverage. The reality is, like I said, I'm also looking to buy names now. I had told you I'm looking at getting back to some of the Mark 7. I'm looking at getting back to some of the AI names. I'm looking at getting back to some of the ETFs, especially those ones that have experienced a very serious down. I'm going to mention a name that is not really popular at this time, but I'm still looking at getting more exposure to the crypto market. I believe that crypto has never suffered the kind of dislocation it is suffering at this point. Maybe, I mean, these are not recommendations. These are not tax advice, so please. I'm just mentioning what I am looking at. Yeah. Not just the crypto, direct exposure to the crypto itself. I'm also exposed to some crypto ETF. I'm talking about specifically, as well as treasury companies. Some names like MicroStrategy. I mean, it's been, because of the price of Bitcoin, it's been suffering as of late. And of course, BMNR. That's a Bitcoin emission, Tom Lee's ETH treasury company. I believe that these assets are being seriously undervalued at this point because of the market sentiment, because of the geopolitical situation that we find ourselves in. And when these will come back up, investors are people that are very afraid. So people like, okay, if AI is going to disrupt so and so things, why don't we stay on the sidelines? That's why you saw this software stocks suffer very unconscionably. But I believe that when investors begin to understand that these software companies, these guys have insane amounts of money, cash flow, cash that they have sitting on. When they understand this, and when they also understand that this is just a temporary dislocation, then it's gonna bounce back. And of course, like I told you, one of the other reasons why we are having a lot of investors questioning the returns on the huge capex spending in the AI sector is because of what is happening in the private credit market. So I believe that when these things, Blackstone literally got 7.2% redemptions. That's insanely high. So that's the kind of a shaky private credit market. But I believe that when these things smoothen out, there's going to be a very serious rally in the broad market, the stock market, the tech stocks, as well as the AI stocks.
Do you foresee a permanent restructuring of the markets, like a permanent movement in the market that will restructure the markets to favor other stocks? If this,
yes, okay. So before these things happened, you looked at the S&P equal weighted index. It grew by 6%. So that means it is moving. We had a very concentrated market where you had, as in last year, like the Mark 7 actually made up 40% of the entire S&P 500. Think about that for a second. What about the 493 left? Now, what that means is that you want to have between 30 and 40% actually So that what that means is that you want to have a general broad-based growth in the market, not just some names, because most of the gains in these mega cap or the Mark 7 were actually driven by AI investment, AI capex spending. That's what drove the market, really. That's not a good barometer for the economy. You want a broad-based growth. And how do you see this? You look at the equal weighted index for the S&P 500. What is happening to the 492 stocks that are not part of the Mark 7? We saw a very decent appreciation. What is happening in the Russell 2000? These are some of the indicators that show you whether there is a broadening out. I believe that after all of this, the broadening out will still continue. Yes, money has started flowing back into the Mark 7, but it's not going to be like robbing Peter to pay Paul. I believe that there is going to be a broadening out of the market, because a broadening out of the market means that the investment or growth is not skewed to one side. When growth is skewed to one side, that's some instability there. That's some instability there. We want to see a broadening out. All of the 500 or most of the S&P 500 companies should begin to experience growth. That's when you can say that the economy is actually stabilizing. And I believe that after now, there will be that shift where growth moves from the Mark 7 and broadens out to other parts of the market.
No, a very nice time having this conversation with you. Let me hear your final take before actually go. What do you predict?
My final take would be, and this is what I will tell people that are listening, don't panic sell. If you panic sell, then you have not learned your lessons. Refer back to April 7th, 2025, where we had the tariff crash. If you made any purchase on April 7th, by the end of last year, by year end last year, you would have been up 39% on the U.S Tech 100. Yes. So don't panic sell. Geopolitical risks are usually over exaggerated. And so when the reality show up that it was actually over exaggerated, the market rallies very hard. So you don't have to panic sell. Rather, manage your risk. If you think you are overexposed to a sector that might come into the crosshairs of the geopolitical conflict that we have now, then you might want to trim your position. But don't sell out. Because when you sell out, you have literally locked in your losses. You are not giving yourself the chance to recover from this. And I believe that we're going to recover. The S&P 500 was actually at 7,000 a few weeks ago. Now it is back to 6,700. We believe that there might be a few dislocations, there might be a few downturns within this year, but the year-end target for the S&P 500 is still very impressive. I'm looking at the 7,800 on the S&P 500. So there is a lot of gains to be locked in if you stay invested. Don't try to time the market. I can't say it enough. Time in the market will always beat timing the market. Dollar cost average if you are not sure. Dollar cost average allows you to smooth out your entries and then remain invested in the market, and you have yourself to thank.
What about the Nigerian market? What do you think of the Nigerian market?
In the Nigerian market, good. Sorry, I got lost because this is a U.S Iran conflict, so I dwell so much in the U.S stock market. So when it comes to the Nigerian stock market, there are a few things. The Nigerian stock market is linked to two things. Number one, if you look at what has happened with the exchange rate, it's been taken up. Naira has kind of dwindled. Not that Naira has lost value, but the dollar has appreciated. Anytime you have a geopolitical conflict, the dollar is always like the safe haven for investors. So, and when the Naira falls, remember what I said in the last podcast, investors are a little bit uncomfortable with investing outside the US. That's why you're seeing what's happened. Just so you know, the Korean index did a 40% year to date. A couple of days ago, it had gone up 40%. and then it crashed to 12.06% in one day. What does that tell investors? It tells investors that there is a higher risk, that the risk of investing in external in other markets is growing steadily. And Nigeria is an external market in this regard. So investors might begin to look at trimming their exposure to those markets. So you might see we expect some moderate sell-off in the Nigerian stock market. But like I said too, this is a temporary reprieve as far as I'm concerned, or temporary dislocation as far as I'm concerned. You want to stay invested, but then again, you want to also trim or reassess your risk. I believe that the Nigerian market might experience some kind of dislocation, but will bounce back once all of this clears off, because investors have seen that opportunities exist outside the U.S. market, and they're trying to take advantage of such opportunities. But again, whenever something like this happens, everybody runs back to the safe haven, which is the U.S. dollar. So we expect the dollar index actually crossed 99. Yes. So that tells you that where investors are running to at this time. But this is just temporary. I believe it's just temporary. This was not going to last forever. So growth will come back to this external market, external markets. And so you want to remain invested, you want to manage your risk, and you want to ensure that you adjust your position accordingly, to ensure that you don't you're not found on the wrong side of it.
Because those actually waiting for Dangote to list its refinery in the stocks that they can buy, they may actually be afraid.
So the thing is that I want investors not to, when you look at a market like Nigeria, don't look at it in isolation. So if you look at the Dangote refinery, for example, Dangote is buying at international price. Brent is going up to $84 per barrel now. So Dangote would buy at that price. Obviously, Dangote cannot afford to literally sell at a loss by still selling at the current price. So you expect, even in Nigeria, we expect, if this drags along for some time, we expect the price of gasoline to begin to tick up. It ticks up, then what happens? Again, like I said, even in the US market, a tick up of gasoline price in Nigeria would lead to a tick up in the price of food.
Almost everything.
Everything. And then what do you think will be the response of the central bank, the Monetary Policy Committee? They would want to do what? Increase the MPR. What that means is that you have a higher potential of inflation, a higher inflation expectation. And the CBN's role is to ensure that inflation expectation is well anchored. So higher inflation means that the CBN will respond accordingly. So we expect the impact to be felt might be felt even in Nigeria in terms of oil prices, price of gasoline, as well as price of commodities. Even food in the market will also be impacted. So I know someone will ask the question, Iran and US are fighting. How does it affect Nigeria? How does it affect the price of food, price of fuel in Nigeria? That's what I've just explained. That Dangote is buying at international prices and needs to tick up the price in order to maintain the margin he's been operating with. So it's actually it's like an evil wind that does no one any good. So we just have to, as people that are in the market, as people that are investors, traders, we just have to ensure that at times like this, we manage our risk as efficiently as possible, so that we'll be able to stay long enough, we'll be able to survive this situation, this dislocation, and then make some decent gains. For people that are in volatility, some people actually trade. For traders, this volatility is extremely good for them if they know what they are doing. But if you don't know what you're doing, it is an opportunity. It could actually be a way of losing your capital very, very quickly. Right. So as a trader, you have to manage your risk. As an investor, you have to be very careful about dollar cost averaging. So you can smoothen out your entries.
All right, thank you. Thank you very much for today. I think we should leave it here. We've done a lot. Thank you very much.
Thank you.
Thank you very much. On that note, we've come to the end of today's episode of Clockwise. Now, if you have further questions, further inquiry, you can drop it in the comment section and we'll respond to you 24/7. Now, thank you for actually watching, but please do not forget to like, to subscribe, and also to put on the notification bell on this channel because of the amazing contents that we drop, and you want to see us every day. And also, do not forget that the illiterate 21st century are not those who did not go to school or those who will not go to school, but they are those who have refused to evolve as their environment is evolving. My name is Providence. See you again.